Tim Baker, Happy New Year. Welcome back to the show.
Yeah, happy New Year. Can't believe we're on the other side of the new year already. The holidays, it's pretty crazy.
We are, and we've got a topic that is connected to the theme of New Year, but of course, we're going to bring it into first personal finance, and that's keeping your investment portfolio fit. Fit standing for fees, inflation, and taxes. Really, three things that are silent forces that can be working behind the scenes on the investment portfolio. You might not always see them directly, but their impact can really be big, especially over time. And Tim, that's where you come in. That's where our team of fee-only certified financial planners come in that have worked with pharmacists, clients all across the country to navigate this topic. This is an area, right, that doesn't really get enough attention since I think it's hard enough to focus on prioritizing saving, let
Yeah,
alone worrying about maintaining the integrity of those savings, right?
yeah, and this, if not paid attention to, can be the drag right on your
Mm-hmm.
portfolio and your ability to build wealth over time. And it's important to especially when you're evaluating your finances, which maybe a lot of us are doing at the start of the new year, to take a look at it and see where we're at with things. So yeah, it can be kind of one of those things that are behind the scenes, especially if you're struggling just to kind of get the portfolio and kind of the wealth building aspect of your finances off the ground.
So, Tim, let's start with fees. We've all heard the saying, you get what you pay for, but sometimes in investing, it might be the opposite, especially regarding fund fees. The more you pay in fees, the less you actually keep in returns potentially. We'll talk about that in more detail. And whether it's from fund management fees to trading commissions, there really can be many hidden costs that can add up, especially in the long term. And it's important that we understand what these fees are and whether or not they're transparent or we're even aware of what they are. So walk us through the different types of fees that investors might encounter on their portfolios.
Yeah, probably one of the most important ones that we talk about is the expense ratio. So the expense ratio is essentially what a fund takes to manage said fund, right? So the way I explain this to him is, let's say I'm a fund manager and I'm managing billions of dollars of a large cap fund, right? So
Hmm.
my job is to, gather information and really buy and sell stocks, large cap stocks inside of my funds that my investor has shares in. So for me to do that, I need a place of business. I need an office space, which might be on Wall Street or thereabouts. I need analysts. I need to pay for information. I need to pay myself, pay salaries. So all of that work that's done, needs revenue to essentially support that. So what the expense ratio is a percentage of the money that the fund manager is managing that they
Hmm.
take out to basically pay themselves and all those things that I mentioned. So the hard part about this is that it's not necessarily a line item on your like account statement. So if you look at sometimes they're listed in the account statement as, hey, you're paying, a half a percent, 0.5%,
Yeah.
or 1%, or 5 basis points, which is 0.05%. So it might be listed as this is what the expense ratio is, but you can't really draw a line from that to like what's actually being taken out of your account, which is hard, right? So and what we often see is that, there's a lot of people that just don't pay attention to this at all. And if we take the example of a large cap, one of the big things which with a large cap is that, you can buy a large cap where you're paying 0.033 basis points, or you're paying way north of that, 1%.
Mhm.
And really the only thing that's different is the fee itself. When you actually like, unwrap that fund and you look at the individual stocks that they're in, it's all the ones that we know, Microsoft and Amazon and things like that. So you're kind of paying a premium for, I don't know what, a name potentially. So it's really important when you're selecting your investments, or if you're working with an advisor and they're helping you select investments, that, you are getting bang for your buck, right? So my thing is like, if I'm going to pay 100 basis points, 1% versus 5 basis points. So that's a 20x difference in fee. For me, the way that I look at this is I should be getting 20 times more performance, or just 20 times safer for the same amount of performance, but it's typically not the case, right?
Mhm.
It's typically not that. So, I can say that, you know, what we typically like to do is drive those fees, that expense ratio down as much as possible, and some of the other fees that we'll talk about, and really let the portfolio do what it does, what the market do what it does. So the expense ratio is a huge part of that.
Tim, when we hear, 5 basis points or 0.05 or 3 basis points, 0.03 versus something like 1%, I think we look at that with a little bit of shock and awe. But, the average investor, if you're not thinking about this, looking at these, if you don't feel them, right, in your portfolio necessarily, it's not impacting monthly cash flow per se. You might look at those and say, how much does that really matter, right? So why does a type of difference when you look at something like 5 basis points or 0.05 versus 1%, over a long period of time? The question really is impact. What is the potential of that impact?
Yeah. So I mean, if you take for just simple math, if you take a $100,000 portfolio and you're in a fund that is charging you 5 basis points, that's $50, per year for that. If we stack that up, so let's say I'm invested in the same type of large cap fund, but it's charging me 1%. That's
Hmm.
$1,000 per year. So like, if we add zeros to this, we can kind of see where this is going, right? So to me, again, like I don't, one of the positions that we pay a little bit more, and they're newer, and more specialized, is like the spot Bitcoin ETFs. Like I think the
Hmm.
the fund that we're in, it's 20 basis point, but typically our portfolios are 4 or 5 basis points, 0.04, 0.05. So what I tell the client, as I tell myself, is like, if I'm paying more and I'm not getting that return, or it's not safer,
Yeah.
it doesn't make sense. So to me, it's driving those down, as much as possible. And you can see the numbers. Like again, like if I look at 1%, I'm like, oh, that's not really that much. But over time and over many years, it's just
Huge.
those are the things that erode your gain, and they don't really need to be. So, um, you know, and to back up, like if you buy an all stock portfolio, like you don't buy a fund, you don't have expense ratio because they're not inside of a fund. You're buying the
Yep.
individual stocks. The danger there is you're potentially, paying commission. So anytime you buy and sell, you are charged a fee. And then just the risk that you take, in terms of like, are you broadly diversified? Are you putting too many eggs in one basket? So what I view as, a good investment practice is I can build a well diversified portfolio, for minimal cost. And again, I would put minimal cost of anything less than, in the 20 to, 10 basis points, like
Yep.
in that range. And feel good about, the construction of the portfolio and the risk that I'm taking. So I do think that I'm willing to pay the toll, the expense ratio for that, and not necessarily buy individual, stocks and bonds, things like that.
So Tim, you mentioned expense ratios. Obviously that kind of becomes the top one that we think about, especially if they're inside of a fund. You mentioned commissions. What other types of fees are out there that folks may not be as aware about?
Yeah, so if you're thinking about trade-in and transaction fees, there are brokerage commissions. So these are fees charged by a broker for executing trades on your behalf. So it could be something like a stock trade commission. These are typically flat fee, so it could be anywhere from $5 to $10. A lot of these have kind of gone. There's a lot of commission-free
Mhm.
brokers, that have kind of squashed a lot of these, but they're still there. If you're option trading, there's option trade commission fees. There's mutual fund transaction fees. So these can range anywhere. When I was in the broker deal world, I think it was almost like $30 per trade, right? Typically the range is, 10 to 50, fifty
Yeah.
dollars per trade. So they'll brokerage will charge us, to buy and sell, mutual funds. There could be like spread costs. So the difference between like the bid and the ask price of a
Hmm.
particular trade. So they might um have a little bit of a spread, so the brokerage is making money. One of the big things that I remember, especially being in the broker dealer world, is account maintenance fees. So these are fees charged for maintaining an account, such as an IRA. And these you see these more, Tim, in like low interest rate environments. So they're not making a whole lot of money on the float of the money that, cash that they're sitting on. So they try to find ways to make money. And these could be I think when I saw them, it was like $50 an account. I see them anywhere from like 25 to $100
Mm-hmm.
annually. Um, Sometimes there's foreign transaction fees. So these are applied to trades on international exchanges. There could be redemption fees. So these are fees for selling certain types of mutual funds or ETF within a specified like holding period. Um, so as an example, like if you look at your account statement and you see like a mutual fund that you have that has an A in like next to it,
Mm-hmm.
that's an A share mutual fund that you were probably sold that had like an upfront commission, right? And a lot of people don't know that up going in, and they pay that, and they're like, "What the heck happened?" There's also C shares that you pay a little bit on the front end, and then you pay an ongoing fee,
Mm-hmm.
um, which is not great. Those are typically the worst ones. And then you have a B one, which is kind of an in between that there's like a holding period that you can sometimes get redemption. So being where we don't we don't operate in them, but I do come across a lot of clients that are like, oh, I'm not paying commissions, and I look at their statement and there's A's and C's. That's what you typically see,
Mm-hmm.
excuse me, all over the place, and they just don't realize it. So, and probably the last one that I hear is kind of like robo advisor fees, right? I'm in a particular program and I'm
Yeah.
paying, a certain amount. So those are the ones that, expense ratio, and then trading fees, transaction fees, and kind of a slew of those that you'll often see.
Is that it? That's all you got on the list of potential fees that are
Yeah, and then we haven't even gotten into the advisor fees, which we can talk about.
Well,
But yeah, yep,
let's talk about that, right?
yeah,
Because obviously, that's the work that we do, and it has to be factored in. And full disclaimer, we're biased in the value of the work that we bring clients. And we believe when you talk about advisor fees, Tim, when it's done well, which is why we believe in the fee only model. That's why we have the model that we do. That yeah, it's a fee, and it's a fee that we have to factor in, but there's a return on investment of that fee that we also have to account for. And not all financial planning services are created equal. And so it's not just a black and white discussion of what are the advisor fees, but what's the construct and the makeup of the advising. And then those fees can look very different and whether they're transparent. So how do you think about the advisor fee piece?
yeah. And I think a big part of this is just like transparency, right? Like
Yeah.
oftentimes, when I'd ask people that have worked with an advisor, like, what are you paying them? They're like, I don't know. Like, and I always tell the story, of when I got into the industry and my parents were working with an advisor. I asked the question of like, hey, what are you paying for that? And it's, the answer I got was like, oh, it's free kind of through your dad's work. And I'm like, there's no free lunch, right? So, and then years later, when I actually looked at it, the fees were significant, like north of 8 grand a year, right? In the
Mm-hmm.
product. So, in the broker dealer world, and again, no shade to that, where it's more like fee based. So you can charge commissions, you can charge flat fee percentages. I think the problem is like, what the advisors try to do is one, help the client, but also make a living. So they'll say, hey, I can get you in this investment, then I earn a commission, or I get you in this investment, I earn kind of an ongoing fee, and then maybe I sell you, a life insurance product that I earn a commission, or an annuity and I earn a commission, or I charge you hourly. So it's
Mm-hmm.
really just confusing, right? So I think like transparency of fee and like what you're paying is really important. And I think marrying that up to like the value that you're receiving, right? So there's some people that they view comprehensive financial planning as selling you an insurance product and managing your money, and that's it. And then maybe talking to you once every couple years. We don't view that as comprehensive financial planning. Like we view that as very light financial planning, if financial planning at all, maybe some investment management. So when you look at the different ways that advisors can charge, fees, it could be a flat fee, it could be an AUM, assets under management, which is a percentage of what they're managing. It can be an AUA, assets under advisement, so it's the investments that they're managing directly at their own custodian, but also managing indirectly, say at like a 401k or a 529. It could be commissions that we talked about, which could be commissions on insurance, it could be commissions on investment, which is kind of what we're talking about here, an hourly fee, or kind of a combination of all these things. So, I think the 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 hard part for the consumer, for the client, is to determine a, like, what the heck are they paying, and are they getting value for that?
Yeah.
And if they're not, then obviously, reassessing it. So, there's there's pros and cons for all of these, right? And there is no such thing as sometimes advisors, especially in the fee only world, will say, we give conflict free advice. That does not exist. It doesn't in any model. There's always a conflict of interest. And I think, the advisors that is willing to say, like, hey, we think this is in your best interest. However, cards on the table, it's also going to change our fee, increase our fee. And that can go the other way too. It's also going to
Mhm.
decrease our fee. Um, I think those are the type of advisors that are, I think, my people. We want what's best for the client, but understanding, what model you're in, and then like what you're actually paying is going to be half the battle. And more often than not, when I talk to prospective clients and I ask them, hey, what are you paying? They're like, literally have
No
no
idea.
idea. And I think that's problematic.
Yeah, and that's what my experience tells me, Tim, is that, especially the pharmacist households that we've worked with, even those that decided, hey, we're not a good fit, and that's okay as well, is transparency is what matters, right? They want to know what's involved. Everyone has a different definition of what is return on investment, what's value. That can change in different seasons of life. So I think the transparency piece is so critical. And if you're in a relationship and you're not sure how the advisor is making their fee, that's a big red flag, right? And I think something worth exploring further.
Yeah. And I think, um, when we talk about fees, like, no model is going to fit everybody, right? So
Yep.
I think, like, it's just, again, being comfortable, understanding what you're paying.
Hmm.
And what I was going to say was, oftentimes, especially with pharmacists, type A, scientific minds, they're like, okay, if I'm going to give you X amount of dollars in fees, what is the ROI? And I'm like, well, define ROI. Because the way that we look at this, the way that we look at ROI is that there is a quantifiable that you
Yep.
can count ROI, but I don't even think it has anything to do with investment returns. I really think the best number in terms of progress with the financial plan is your net worth, right? The assets, the things that you own minus the liabilities, things that you owe. But I think the other unspoken thing here is the not the quantifiable things, but the qualifying things
Quality.
of what have we done with your plan, with your life plan supported by the financial plan. That's hard to count, whether it's
Hmm.
that family that finally could buy the house when they didn't think they could, or had the baby, or retired early, or pivoted careers, or got back into a passion that they had put on the sideline for a long time because of whatever reasons. Those are the things that get me fired up that have nothing to do with
Hmm.
ones and zeros in the bank account or net worth or things like that. And I think if you're in that type of relationship and you have that type of trust and rapport, that's worth a lot. So that's my soapbox, Tim.
No, I agree, and I would be remiss if I didn't put a plug in here for what we do, and for those folks listening that would like to learn more about our fee only financial planning services, what our team of certified financial planners can offer, working with households all across the country virtually. You can learn more at yourfinancialpharmacist.com. You'll see an option at the top right. You can book a free discovery call to learn about those services. Tim, let's shift to inflation. So, in addition to fees, we have to pay attention to inflation. And this one feels a little bit sneaky, right? I mean, you're making money, but inflation is quietly chipping away at your purchasing power. Yes, today at the grocery store, I think we've all felt that recently, and perhaps 5, 6 years ago it was, hey, inflation, what? But we all have felt that more recently. But not only in our expenses today might we feel that, but also in the future when we think about how far our savings will go. So explain to us how inflation erodes the purchasing power of an investor's returns over time.
Yeah. So when I talk about, like, because there's a lot of people out there that are super risk adverse, right? So they're like, Tim, do I really have to invest? Can I just, like,
Hmm.
stuff my mattress or put money in my bank account, my high yields, and like call it a day? And the answer is, like, especially if we're aspiring to be a seven-figure pharmacist, plug the book. The answer is no, you can't. And the when I talk about this, with in different talks, like, when I look at inflation, if we take a latte that you buy at Starbucks in 2025, and let's say it costs $4, and maybe that's just a plain coffee these days, but if you get that coffee at $4, if we use historical rates of inflation, and most advisors will use about 3%. Now, we've had years of spikes that, some people are like, well, let's use 3.5 or 4%. But if we use 3% and we fast forward 30 years from 2025 to 2055, that same latte that would cost $4 costs $10 30 years from now. So what that means is that your dollar just goes less far. And this is why my dad's in his 70s. He'd always talk about, his grandparents would give him a nickel and you go to the candy store and buy half the store, it seemed, right? You can't buy anything for a nickel today, right? So the idea of investing and having a solid investment plan is to keep pace with the inflation monster, but then also get ahead of the tax man, which is what we're going to talk about next. So unfortunately, we can't bury our head in the sand, or and I say that facetiously, and just put money into a checking or a savings account and call it a day. Because over time, that $400,000, if we look at it from an investment, is going to be equivalent to $1 million,
Yeah.
or the purchasing power of $1 million in the future. So that's why we need to invest and take appropriate risk in equities and bonds. And I would argue equities, mostly through, the working years of most people, especially early on. And then as we get closer, start to add more bonds and fixed income. But that's really what it is, because, every year, the price of goods and services goes up.
Hmm.
And it's a systemic thing that we can't escape, that we really have to adapt our financial plans to.
Yeah, and I think, Tim, it can be easy to lose sight of historical trends when we're in
Yeah, for sure.
cyclical time periods, right? So, I'm thinking of this moment while we're recording. Although rates have come down, high yield savings accounts are 4% ish, right? Give or take.
Yep.
We've had historically high inflation, the last couple of years for obvious reasons we've talked about on the show. And so I think sometimes people look at that and they say, oh, well, 4%, that's really good, historical rate of inflation. But we can't confuse those, right? Because just a few years ago, what was our high yield savings account earning? Less than 2%.
Yeah.
I mean, for a while, right down there. I mean, even lower than that. So
I
when we
remember it being
zoom
at
out,
1%. Yep.
yeah, we get those emails, right? Your
Yep.
savings account has gone down. But, if we zoom out, we look at the historical rate of inflation. If we're not investing and taking some level of calculated risk, and what that risk tolerance and capacity is different for everyone, and that has to be customized. But if we're not doing that, right, our long-term investments really come to be at risk in terms of us achieving our long-term goals.
Yeah, and I'll give you an example. So if we're talking about the long-term effects of inflation. So over time, inflation compounds, meaning its cumulative effect on purchasing power grows significantly. So like if we take $100,000 portfolio and we invest it at, we get a 6% annual return over 20 years. Without inflation, that portfolio grows from 100,000 to 320,000, we'll call it. If we then interject reality, which is about a 3% inflation, the real value of that investment, if we adjust for inflation, would be 180,000. So that's the rub here. And again, that's why, when people are like, oh, I'm like really conservative, I don't want to take risk. I'm like, you kind of have to get in front of this, especially in, in your younger years, to get in front of, again, inflation and then the tax man.
Yeah, and this is also why when we're doing things like retirement projections, nest egg calculations, especially for people that are maybe in that, front half of their career, let's say, they look at
Yep.
these numbers and they're like, is this wonky math, right? These seem like they're huge, they're out of reach. Well, we're thinking about it in today's dollars, and obviously we have to be thinking about it in the future as well. Tim, you alluded to retirement age a little bit when you're talking about asset allocation. Let's just touch on that a little bit more. So for maybe some of the pre-retirees listening, or people that are in the second half of their career that are thinking about retirement, it's on the horizon, and are concerned about the long-term effects of inflation on their portfolio's ability to generate income and to sustain itself. What are some general strategies that we're thinking about employing? I know you've talked before on the show about, hey, Social Security, right? It's one of those rare vehicles that we have some inflation protection. What other thoughts here?
Yeah, I think as you look at your investment strategy, like there are things that, yeah, you mentioned social security. That's why we're a big, a big believer in really having a very purpose-based strategy when it comes to social security claiming, because once you make that decision, it's kind of forever. And that can really affect the amount of inflation protected income that you have coming in the door. So the other things you can think about is there are inflation protected securities. So there's TIPS, Treasury inflation protected securities that are linked to, they're kind of marked to inflation. So as um, inflation goes up, so does the interest payments for which you receive. They're not necessarily growth oriented, but it helps you kind of at least keep pace with that. What we've been talking about, at length here is really having a portfolio that's invested in growth-oriented assets. So stocks, real estate, could be commodities that outpace inflation over time, that kind of provides a hedge against inflation. Reinvest in your returns. So compound and helps offset the negative effects of inflation over time. Another thing that, again, we believe in, that not everyone does, but even diversify internationally. So investing in global markets may reduce inflation, um, tied to kind of the US dollar or the economy. And then probably the big thing I hear or I see, and I actually just had a conversation with a prospective client, they were sitting on over $200,000 of cash, and I'm like, well, why? And part of it's monitor cash holdings. So cash lose, unless it's in a high yield and it's kind of getting close to that, in today, 4%, cash loses purchasing power quickly in inflationary environments. So you want to really limit the cash that you have idle. So we kind of talk about, you want your emergency fund and any short and medium term goals that you need cash for. So that might be a trip, might be a project on your house, et cetera, et cetera. And that foundation is set to then get money into the market for more, longer term type planning. So those would be things, like I mentioned, it could be, what you invest in, whether it's tips, growth equity type of stocks, could be commodities, but then also some of the things that you're doing, with cash and how you reinvest returns and things like that can help kind of tackle the problem, that won't ever go away, which is the inflation associated with your assets.
Yeah, one last thing I would add in here, Tim, and this is where I think the flexibility piece is so important. And we've talked at length on previous shows about this, but if someone has some flexibility with their retirement situation, whether that be part-time work, whether that be the timeline of when they retire, and we're in a high inflationary period or a downturn in the market, right? Things that we may not anticipate happening, those types of levers that we can pull go a long way in terms of how we maintain the integrity of our investment pie as we go throughout retirement. So it's not a set it and forget it. So important when we think, I think back, Tim, to my early years of saving, coming out of pharmacy school. And it's like, all right, we're going to pay away whatever, 20, 25% of our income. And we'll kind of think about this
Yeah.
tomorrow. And that's good early on. But then you get to this point in time where we start to ask this question of like, hey, are we on track? And, what is the horizon timeline? And then more nuanced questions like some of the tax strategies when we think about withdrawals, or, hey, the market's had an unexpected downturn, or we're in a down market for a longer period of time. And maybe it's not the best time to retire, or maybe I could retire early, right? There's all these wrinkles that we have to consider as we get closer to that timeline.
Yeah, and probably the timing of when you retire is going to be one of the most important things that
Yeah.
is related to your success in terms of having your assets not run out on you.
All right. The last piece of our keeping your investment portfolio fit, fees, inflation, taxes. Taxes is number three, certainly last but not least. This is a big one, right? They could take a huge chunk out of your investment income, particularly if you're not strategic about it. We've harped on that on this show many times before about being proactive with your tax planning and how important that is to the financial plan. And whether it's not maximizing tax advantage accounts, whether it's realizing, capital gains taxes when you're selling investments, or taxes on interest income. If you're not paying attention to taxes, Tim, it can really hurt your returns. And I think tax is just one of those dry topics that, hey, we'd rather not really think about.
Yeah, and it's another one. It's another one that has major implications on, again, your ability to grow your wealth and keep pace with lifestyle, especially in retirement and really throughout your whole life. So, I think one of the big things that I think about, so when I talk about taxes and investment, I kind of lead with a little bit of a depressing like example. So like if we look at $1 million in a traditional 401k, $1 million in a Roth IRA, $1 million in an HSA, et cetera. One of the questions I always ask is like, how much money do we actually have? And unfortunately, we don't have 3 million or $4 million, how many bucks it is, because anything that is gone into a pre-tax bucket, like a traditional IRA, a rollover IRA, a traditional 401k, Uncle Sam has yet to take his bite of the apple, right? So the mechanics of this is like if I put money into my 401k, let's say I put 20 grand in, I make $100,000 a year. The IRS looks at me as if I made 80,000. So I get a deduction for that. So that 20,000 goes into my 401k. It grows tax free, which is great, which means I'm escaping capital gains. I don't have to pay capital gains. And then when I pour that money out in retirement, that's when it gets taxed, right? So if I have, over time, I have $1 million there and I'm in a 25% tax bracket, actually 750,000 of that is mine and 250,000 of that is the government. So I think what's really important about taxes and investment is actually something called asset location. So these are different types of investment accounts that have different tax treatments. And the three main buckets here, Tim, are the tax deferred accounts, which I just talked about. So this is kind of a traditional 401k, traditional IRA. So these contributions are pre-tax and the investment gross tax deferred. And then the withdrawals are typically taxed at ordinary income levels. We have the tax-free accounts, which is a little bit misleading because you actually pay the taxes, as it goes in. So these are things like Roth IRA, Roth 401k. So the contributions are after tax. So I got my paycheck, I've already been taxed, and I put those money into a Roth. That investment grows tax-free, and the withdrawals are then tax-free. So when I pour out that money, so if I have $1 million in a Roth IRA, I pour out all $1 million of that, I actually get all $1 million. And then the last one is the taxable accounts. These are the brokerage accounts. So these are taxes. Taxes are paid annually on interest, dividends, capital gains. Typically, the contributions are with after-tax dollars. So I was taxed on it through my paycheck. I contribute that to a taxable account. It grows, but then any capital gains, interest, dividends, I'm taxed again. And that's where we get into things like tax loss harvesting. So, depending on where you're at in geographically, where you're at in life, you want to have a little bit in column A, a little bit in column B, a little bit in column C, right? So it's really important to be able to, when we're building, if we fast forward to retirement and we're building a paycheck, if I'm the maestro and I'm building a retirement paycheck, I know that maybe we're getting some in from consultant part-time work, Tim. Maybe we're getting some in from Social Security, which is also taxed. But then the gap that I'm trying to make up between those things and what we need to, live and thrive, I'm pulling from these three buckets. And, if I have a balance of those three buckets, it benefits me because what I'm trying to do as a planner is fill up your tax bracket in the most efficient way possible. So I might take some from the pre-tax bucket to get you to to max out that 12% tax bracket. And then maybe I go to the Roth to then, get the rest. Maybe we're retiring at 58. So then I'm using primarily a brokerage account because anything before 59 and a half, I get a penalty and pay taxes. So, excuse me, that's the asset location is really important to determine how we then pull it in retirement and what makes the most sense efficiency wise from a tax perspective.
Yeah, and what you're talking about, Tim, is building a retirement paycheck, right? We talked
Yeah.
about this on episode 275. We'll link to that in the show notes. But I love that visual because we all can relate to that, right? Throughout our career, whether we work for someone else or we're self-employed, we have some semblance of a paycheck. Maybe it's fixed, maybe it's variable, over time. But eventually, we're going to get to this future state where maybe we're working part time, or eventually we're not working at all. or we have to produce our own paycheck. And there's going to be multiple sources that are feeding into that. You mentioned it could be Social Security, it could be an annuity, it could be coming from an IRA, it could be coming from real estate, it could be coming from a 401k, right? All these different pathways. And it highlights so well the point that not all buckets and dollars are created equal, as you articulated so well. You could have two people that both have $4 million, and where that $4 million is going to go and how it's going to be deployed could be very different depending on what
Correct.
buckets from a tax standpoint. And it's important on the front end. So we're talking withdrawal side with the building the retirement paycheck, but it's also important on the front end as we're saving, not that we can predict everything that will happen in the future. But if someone says, hey, Tim, I want to retire early, and they're serious about that, well, we got to think about where those buckets of dollars are going to be and how do we build a plan and a way to support that. So, this is where online nest egg calculators fall short, right? Just punching in numbers and saying, hey, Tim, you need $3.4 million saved. Like where, how, what's that going to look like? What are the tax treatments? All those questions have to be answered.
Yeah, and it's so nuanced, right? Even like we talk about our own situations, like we're two Tims in Ohio. Our financial situation is similar but different. But even with a slight variation, we just there's certain things that I'm doing in my plan that you're not doing, and vice versa, right? Like one of the cool things about being self-employed in Ohio is, your first $250,000 per year, there is no state income tax. So, when I moved from Maryland, I'm like, oh, like I need to really take advantage of that and hit my Roth harder than what I was, because I'd rather pay the tax now, i.e. just pay federal. And then, use another example, like if I decide to retire in Florida, maybe I don't need to do that, but I'm not planning on doing that. But, if you're working in a state with income tax and retiring with a state that doesn't, again, there's legislative risk there because, things could change. But all of those things kind of play a part in this journey, which is what it is. And it's hard to get that from a calculator, and it is nuanced, and I think it requires a level of care and attention, especially when we're talking about the nest eggs and the assets that we're working with over time, that just requires some level of love and attention, really.
Tim, great stuff. We covered a lot in a short period of time. Fees, inflation, taxes, three really important parts as we think about our investment portfolio. And we really are just scratching the surface on all of those areas. We'll link to some of the episodes. We've got more information in the show notes. Thank you so much, everyone, for listening to this episode of the podcast. If you like what you heard, do us a favor, leave us a rating and review on Apple Podcasts, or if you're watching on YouTube, which will help other pharmacists find our show as well. And finally, an important reminder that the content in the show is provided for informational purposes only, is not intended to provide, and should not be relied on for investment or any other advice. Information on the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. For more information on this, you can visit yourfinancialpharmacist.com/disclaimer. Thanks so much for listening. Have a great rest of your week.